Talking about worldwide tax systems versus territorial tax systems, the worldwide system, this is a tax system in which individuals are subject to taxes on their worldwide income, regardless of where it was earned. This means that a U.S. citizen working and earning income in a foreign country would still be required to pay U.S. taxes on that income. However, we've got a territorial tax system, and we're just understanding what these terms mean. If we see a territorial tax system, only taxes citizens on income earned inside its borders. This means that if a U.S. citizen earns income in a foreign country that has a territorial tax system, they may not be required to pay U.S. taxes on that income. So just be familiar with these terms. Just general, nothing too crazy. This is kind of a fun little grab bag lesson. We love these lessons, don't we? Foreign tax credits we're looking through here. These are a way to mitigate double taxation. So one thing you could commonly see is if you've got an investment, this is something I've dealt with, where you buy stock in a company on the U.S. stock exchange. However, it has a lot of foreign operations. It might pass along foreign items to you. You'll see it on maybe on a K1 if it's a real estate investment trust or something. Not to get too far down a different conversation. But you'll see that you did, in essence, pay foreign taxes. And then you can take a foreign tax credit. So mitigating double taxation there, who are subject to a worldwide tax system. This means that if a U.S. citizen earns income in a foreign country and pays taxes on that income to the foreign country, they may be able to claim a credit on their U.S. taxes for the foreign taxes paid. So we were dealing with before our corporations. I mean, this kind of applies to corporations. Same similar process. And we also have individuals. The exclusion by category is a way to categorize different types of income for tax purposes. There are several categories, including passive category income, general category income, foreign branch income, and global intangible low taxed income. That's that GILTI item, if you've seen that or ever been familiar with that before. Let's dive into these categories of income. So for foreign tax credits, what are our various categories of income? First off, we've got our general category income. This is a broad classification that's going to include most types of foreign sourced income that do not specifically fall into any other category. So if it doesn't go into one of these other ones, put it in the general category. Examples of general category income are going to be salaries, wages, dividends, interest, royalties, not derived from passive activities, because if they're passive activities, they'll go in the passive category income. The FTC for the general category income is calculated based on the taxes paid or accrued on this type of income in foreign jurisdiction. That stands for the foreign tax credit, if you were not aware. The limitation is going to be determined by the ratio of foreign source taxable income in the general category to the taxpayer's total taxable income from all sources. Diving into foreign branch income, this category was introduced by the Tax Cuts and Jobs Act in 2017 to address the income generated by foreign branches of U.S. companies, remembering the difference between our foreign subsidiaries, foreign branches, all that good stuff. Foreign branch income refers to the business profits earned by a U.S. taxpayer's foreign branch operations. Now, these operations are distinct and separate from the U.S. business and are conducted through a separate legal entity. The foreign tax credit limitation for this category is calculated by comparing the foreign source taxable income attributed to the foreign branch with the taxpayer's total taxable income from all sources. And then lastly, we've got our passive category income. Now, this is going to generally include income from investments and other passive activities. Absolute shocker there. Didn't expect to see passive income in the passive income category that do not require substantial effort or active management from the taxpayer. Some examples here are going to include income from interest, dividends, rents, royalties, and annuities. Hey, I don't know what you're saying. I work hard for my interest that I sit on my butt and collect from the bank that are not derived from an active trade or business. Passive category income also covers gains from the sale of property, generating passive income, and some types of income from foreign corporations. With this, just be generally familiar with these categories, what would fall into it. Not likely to see a sim or lots of multiple choice on it, just understanding the types of classifications. Well, we see an example here. Like I said, it's not like you have to likely do this for a sim, but let's dive in and see what we got. We've got Tectonic Corp. It's a U.S. corporation. They develop and sell innovative software solutions worldwide. Sounds awesome. Good for you all. It records sales of software solutions during the year to the following customers. We've got Quantum Corp, all these fun names, which is a foreign corp for use in its IT department in New York. We've got Orion Corp. This is another foreign corp for use in its IT department in Germany. We've got Nebula Corp. This is another foreign corporation and a related party. See how that plays a role for its use in its IT department in France. And lastly, we've got Starlight Corp. This is a U.S. corporation for its use in its IT department in Japan. Which transactions increase their foreign-derived intangible income? Interesting. Okay, foreign-derived meaning it's going to likely be from, deal with foreign sources completely. Intangible income, because this is going to be software. Software is intangible. Show me some physical software. I can't imagine I've ever seen that. Now, what are our answers here? It's going to be 2 and 4, meaning Orion and Starlight. And we'll talk about the explanation, but what looks different about these? We've got a foreign corporation, and it's going to have an IT department in Germany. And then we got a US corporation. It's got an IT department in Japan. Now, we see that the ones that are not included are going to be the one that's the related party. And then this one is doing business in New York. So we'll see how that plays a role. Now, foreign-derived intangible income is calculated based on a U.S. corporation's income generated from serving foreign markets. Diving in here, in this example, the following transactions meet the criteria for increasing tectonic corporations. Foreign-derived intangible income, what a mouthful. That is a lot to say. We've got, first off, the sale to Orion. Now, Tectonic Corp sells its software to a foreign company for its use outside the U.S. I feel like this one's pretty straightforward. This transaction qualifies as FDII because it involves a sale to a non-U.S. person for use outside the U.S. So that's very much distinctly all foreign. And then next we have the sale to Starlight Corp. Now, Tectonic Corp sells its software to a U.S. corporation for use outside the U.S. Well, although Starlight is a U.S. corporation, the software is going to be used outside the U.S., which makes the transaction eligible for increasing the FDII. Now, if you were wondering why these other two did not count, well, we are going to dive right in and walk it through. These other two transactions are not going to increase the FDII because, for example, the first one, Quantum Corp, the software here is being sold to a foreign corporation, but it's going to be used within the U.S. And if you didn't know, New York is in the U.S., so I'm learning new things every day, just like you. FDII only applies to income generated from serving foreign markets. And then next up, we got Nebula. While the software is sold to a foreign corporation and used outside the U.S., which is France, Nebula Corporation is a related party to Tectonic Corp. Now, sales to related parties are subject to additional scrutiny, and depending on the relationship and transfer pricing policies, this transaction might not qualify for FDII. It's not like this is some wild trick you're going to commonly see on the exam. This is just, as I mentioned, an example to demonstrate how this is all working. What's the point? And what's the point of anything? This is all very important. Don't you worry. That's it. That's a nice example. Let's keep diving through. Now, we've got another example here. We've got Gem Supplies, Inc., which is a U.S. corporation. They are a wholesale distributor of electronic components. In year 4, Gem sells electronic components to Tech World Limited, which is a UK corporation. Gem ships $400,000 in electronic components to Tech World's headquarters in London, in the UK, and $350,000 in electronic components to Tech World's warehouse in New York, New York, with title passing upon delivery. In addition, Tech World pays Gem $45,000 to provide technical consulting services at its headquarters in London. What is going to be Gem's U.S. source and foreign source income in year 4? Great question. I'm glad you asked. Now, our answer here we see, but how do we get that answer? That's probably more important than the answer. We've got U.S. source income of $350,000 and $445,000 of foreign. Shocker, the 350 is coming from there, and the 445 is the 400 plus the 45. Now, here we see that Gem Supplies Inc. has both a U.S. source and foreign source income. This is going to be based on the location of the activities that generated the income, which makes sense. The sale of electronic components to Tech World's warehouse in New York is considered U.S. source income because the title passes upon delivery within the United States. And in this case, the U.S. source income is going to be $350,000. Now, for the foreign source income, the sale of electronic components to Tech World's headquarters in London and the provision of technical services at the headquarters, which is outside of the U.S., are considered foreign source income because these activities occur outside the U.S. In this case, the foreign source income is going to be the 400 from the sale of physical components and then the 45 from consulting services. Very good. Gotta love these examples. I know you all love them. That's why we got so many in this throughout Reg. This is something that was requested, and I hope you all are enjoying them. Nothing too crazy here. I did mention the GILTI tax before, and we've got this BEAT tax. The global intangible low tax income tax. I'm going to lose it with the amount of just the words here, but that's why they got the acronyms, right? It's a minimum tax designed to disincentivize people from keeping their money in low tax jurisdictions. It applies to U.S. shareholders of foreign corporations. Really just be familiar with that term, but you're probably not going to see either of these in the exam either. The base erosion and anti-abuse tax. It's another tax aimed at preventing corporations from shifting profits to low tax jurisdictions. It applies to corporations with annual average gross receipts of at least $500 million and has a current tax rate of 10%. Like I said, nothing too wild. I'm not going to spend much time on this slide. Let's deal with PFICs and Subpart F. PFICs, gosh, I remember my time working in tax in the alternative asset management space. That was a word. I'm going to bring back too many memories, good and bad, by thinking about this. But let's dive through. So all these rules are here to try to bring income back to the U.S. rather than having high net worth individuals. Generally, that's going to be who we're dealing with here. Having their income, having their investments outside the U.S. and not paying U.S. taxes on them. So anti-deferral rules are designed to prevent U.S. taxpayers from deferring U.S. taxation on certain types of income earned in foreign countries. The U.S. trying to claw all of that income, that sweet, juicy money back to the U.S. These rules target specific categories of income, such as passive income, or certain types of income that lack economic connection to the country of origin. We've got two main anti-deferral regimes. These are going to be the PFIC rules and the Subpart F rules. Now, first for the PFIC rules, these apply to U.S. taxpayers who hold an interest in a foreign corporation that meets either the income test or the asset test. Simply put, the income test is met if 75% or more of the corporation's gross income is passive. The asset test is met if at least 50% of the corporation's assets are passive assets or are held for the production of passive income. Simply, you just got to meet those tests. When a U.S. taxpayer holds an interest in a PFIC, this is a company or organization that is declared PFIC based on these rules, they may be subject to U.S. tax and interest charges on certain types of income such as dividends, capital gains, or excess distributions from the PFIC. Now, what about Subpart F? Subpart F rules, this is not something I dealt with, but something I can explain for you here. Subpart F rules apply to shareholders of controlled foreign corporations and target certain types of income earned by the CFCs that have no economic connection to the country of origin. Subpart F income includes categories such as foreign-based company income, passive income, and certain types of related party transactions. Now, the Subpart F rules require U.S. shareholders of a CFC to include certain types of undistributed income in their gross income, even if the income is not repatriated to the U.S. This is intended to prevent U.S. taxpayers from deferring U.S. taxation on foreign income earned through the CFCs in low-tax jurisdictions. And lastly, the inclusion of Subpart F income in a U.S. taxpayer's gross income is subject to special tax rates and limitations. Well, did you see some examples here? This is something, these QEFs and MTMs, that's something I saw back in the working world. Not that I'm not working here, just busting it out, getting a lot of work. Hope you all are surviving your work as well. This accounting world, it's quite demanding, isn't it? Now here, first we're going to see the PFIC rules. Now assume that John, a U.S. taxpayer, invests in a foreign corporation, which is ABC Inc., that generates mostly passive income. We're going to visualize what we were just talking about on the prior slide. John's investment in ABC is considered a PFIC under U.S. tax law. In year one, ABC earns $100,000 of passive income, but does not distribute any income to John. Now, under PFIC rules, John must include the $100,000 of passive income in his gross income, even though the income is not repatriated to the U.S. So even though the money's still sitting out there, it's not in the U.S., and likely you're not benefiting from it, you still have to pay taxes on it, which you hate to see it. John may be subject to additional taxes and interest charges on this income. To avoid the charges, you may elect to apply for these. That's not going to be important for our exam. But if you're an absolute tax nerd, which is not a bad thing, hey, if you're good at anything, I applaud you. This was something I used to be a lot more familiar with. But if this is something you know, then tying it all in and hey, this is real, right? You see this in the real world. Next, we got our Subpart F rules. Assume that XYZ Inc., a foreign corporation, is a CFC with U.S. shareholders. Now, in year one, XYZ earns $500,000 in Subpart F income, which is income that has no economic connection to the country of origin. XYZ Inc. does not distribute any income to its U.S. shareholders. Now, under our Subpart F rules that we talked about, the U.S. shareholders of XYZ must include the $500,000 of Subpart F income in their gross income for year one, even though the income is not repatriated to the U.S. So again, you hate to see it. It's income that was not brought back yet, but you still have to pay tax on it. The inclusion of Subpart F income in the U.S. shareholders' gross income is subject to special tax rates and limitations, which we don't got to worry about too much. Talking about the substantial presence test, this is something that came up all the way back in dealing with individual income taxation, dealing with filing status, and is someone a U.S. person? We'll talk about that there, and we'll talk about that here. Now, dealing with the substantial presence test, this applies throughout, and all the way back in that lesson, I did mention it would be coming back again. Coming back to haunt you, right? This is a way to determine if a foreign individual is considered a U.S. resident for tax purposes. We know the tax code is different than just general law, so I'm not an expert on immigration or anything, but you might not be legally considered U.S. citizen at all, but the U.S. government with the IRS, they consider you a U.S. citizen, and as such, lots of significant tax implications because of that. Now, a person meets the substantial presence test if they are in the U.S. for at least 31 days in the current year and at least 183 days in a 3-year period. Now, does this mean if you just go on a 31-day vacation in the U.S., you're going to be considered a U.S. resident and have to pay a lot of taxes on money? Well, no. I mean, it's presuming that you were not working here, maybe running around doing the sightseeing. I just found out that New York is part of the U.S. You saw New York, maybe you went all the way out to California. Moving on, for example, if a U.S. resident receives income from a U.S. branch of an entity, the individual would simply include that income on whatever normal form it belongs on. However, if the individual is considered a foreign person, if they receive income earned by a U.S. branch of a company, they would have to file a Form 1120-F, which is a foreign corporation U.S. income tax return. This is something I dealt with where I had a friend who was from another country, came here, worked for a year, and paying, she was like, oh, U.S. taxes. Please deal with this for me. And I said, okay, sure, I'll help you out. The dividends received deduction with foreign entities. I mean, I feel like we talk about this to death, but now we're seeing it with foreign entities. Dividends received deduction, absolutely critical for the exam overall, SIMS, multiple choice, everything with that. But let's talk about how it relates to foreign entities. Well, let's just reintroduce ourselves to it. The DRD, it's a U.S. tax provision that allows a corporation to deduct a portion or all of the dividends received from another corporation, thus reducing the tax burden on that income. The Tax Cuts and Jobs Act introduced a new tax provision called the 100% DRD for certain foreign income types. Now, this deduction is also going to be referred to as the participation exemption. Diving in further, the foreign income types eligible for 100% DRD include dividends from a specified 10% owned foreign corporation, also known as an SFC. A U.S. corporation can claim 100% DRD for dividends received from a specified 10% owned foreign corporation. A specified 10% owned corporation is a foreign corporation in which the U.S. corporation is a U.S. shareholder owning at least 10% of the voting stock. The U.S. corporation must have held the shares for at least 366 days during a 731-day period, starting 365 days before the dividend X date. This whole thing here is basically saying that, well, before this all happened, if you had investments in foreign entities, you'd have to pay tax on those dividends. This was a tax provision that came in to help corporations to not be as heavily taxed on their foreign investments. Is that a good thing? Is that a bad thing? I don't know. I'm not a corporation investing in foreign entities. I'll leave that up to you to decide. Moving on, we've got the dividends received deduction with foreign entities. Well, we want to assume that ABC Corporation is a U.S. corporation that owns 15% of the voting stock of XYZ Corp., which is a foreign corp. ABC Corp. Has held the shares for more than 366 days, so one more day than a year, during the required 731-day period, and XYZ Corp. Declares a dividend of $1,000 to ABC. Under this new tax provision, the ABC Corp. Can claim a 100% DRD for the $1,000 dividend received from XYZ Corp., reducing the tax burden on that income. This means that ABC Corp. Can deduct the full amount of the dividend, $1,000, from its taxable income, resulting in no U.S. tax liability on that dividend income because it meets all the rules we talked about prior. Without the 100% DRD provision, ABC Corp. Would have to include the $1,000 dividend in its taxable income and pay U.S. corporate tax on the amount, which that doesn't sound very fun, subject to other foreign tax credits. Now, with this new 100% provision, we are able to avoid U.S. taxation on the dividend income from its specified 100%, not 100%, 10% owned foreign corp. I'm losing it, 100%, 10%, back and forth, 15%, going once, going twice. If I'm losing it, hopefully you're not losing it. You got to keep mental sanity going for both of us. Hey there, are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.